Everyone thought Intel was finished. But the stock is up 496% in the last year. The question is Intel finally back, or has the market already priced in a full recovery? I'm Edward Kalstian, founder of Egg Capital, where we look for market-beating stocks for the long run. Today, we're breaking down Intel through our 5 key factors: economic moat, return on capital, growth, financial strength, and valuation. Stick around for the valuation section. At the end, we'll compare Intel directly to NVIDIA and AMD. And the data shows the market might be making a massive mistake. Let's get into it. The moat is always our starting point, because if a company can't protect its profits from competition, everything else is irrelevant. Morningstar currently rates Intel no moat. That one rating explains almost everything about Intel's situation today. For decades, Intel had a wide moat built on 2 advantages. First, the x86 instruction set license, one of only 2 in the world alongside AMD. That created massive switching costs across PCs and enterprise servers. Second is manufacturing leadership. Intel didn't just design chips, they built them in their own factories. This integrated model let it benefit from Moore's law, repeatedly producing faster and more efficient chips while funding future generations of research and development. That created a powerful flywheel, then execution broke down. Intel fell behind TSMC in manufacturing, and AMD took advantage by outsourcing production and bringing stronger products to market faster. Intel lost its manufacturing edge, and with it, its moat. Today, Intel still has meaningful chip design capability, but instead of becoming an asset-light chip designer, it's trying to rebuild its manufacturing advantage and compete directly with TSMC again. Early signs of progress exist, but execution remains uncertain and any moat recovery is likely years away. Intel also benefits from a strategic angle. As one of the only US-based companies attempting leading-edge semiconductor manufacturing, government support through national security considerations may provide long-term tailwinds. But it doesn't eliminate the competitive pressure from TSMC or AMD. Intel is not a moat story today, it's a turnaround story. Every data point in this video comes from Fiscal.ai, the platform I use for every stock analysis on this channel. Link in the description for 15% off. Returns on capital tell us how efficiently management converts investor dollars into real profits. Stay with me through this section. The growth numbers coming up next will show you whether Intel's returns can ever recover to where they once were. Intel's return on invested capital is 0% today, recovering from minus 12.8% last year. The trend shows a painful multi-year decline from peak ROIC of around 20% in 2018. A collapse into deeply negative territory in 2024, and now the very early stages of recovery. Before the peer comparison, just like in my NVIDIA and AMD videos, I'm showing NVIDIA separately because their fiscal year ends in January. This would distort the chart otherwise. NVIDIA is in a completely different league at 135.4% and accelerating. Among the remaining peers, I'm showing from 2017, as 2016 was an extreme outlier. Broadcom is stable at 17.1%, AMD at 6.6% slowly recovering, Intel at 0% is the weakest, but the direction is right. Same story on return on equity. Intel at 0%, recovering from minus 17.9% last year. NVIDIA shown separately is exceptional at 101.5%. Broadcom is solid at 31%. AMD at 7.1% and improving. The honest question here is whether Intel can get back to the 20% plus ROE range it held from 2018 through 2021. That answer entirely depends on the growth story, which is exactly what we're covering next. Growth is the engine that drives long-term value creation. And Intel's growth story is probably the most complex of the semiconductor companies we've covered on this channel. Over the last decade, revenue has been essentially flat and declining, resulting in a negative net income. A 10-year earnings per share CAGR isn't meaningful due to losses. For peer earnings per share comparison, NVIDIA, shown separately, has delivered an extraordinary 69% earnings per share CAGR over the last decade. For Broadcom and AMD, I can't compute a clean 10-year CAGR due to negative earnings in 2016, so I'm using the last 5 years. Broadcom at a solid 33.5%, AMD flat at 1%. But the forward picture is where things get more interesting and more uncertain. Analyst estimates show Intel's earnings per share recovering from minus 0.1 in 2025 to $2.21 by 2028. That's not explosive growth, but it would represent a meaningful return to profitability. What's driving it? First, AI and server CPU demand. As AI workloads grow, demand for server infrastructure increases, creating an opportunity for Intel's data center business. Even if Intel continues losing share to AMD, a growing market could still support growth. Second is Intel Foundry. If Intel can attract external manufacturing customers, it could build a second growth engine beyond CPUs. A preliminary agreement with Apple to manufacture some chips is the most promising signal yet. Though it's far from certain, Intel can deliver on its most advanced, next-generation manufacturing process to meet Apple's exacting standards. Intel has missed manufacturing targets before, and Apple's well-known perfectionism leaves very little room for error. Intel needs to execute across 3 fronts simultaneously: rebuild manufacturing, grow server CPUs despite share losses, and win foundry customers. Promising, but the most execution-dependent story in semiconductors today. Financial strength is our sleep-at-night factor. And for Intel, this section is more nuanced than for NVIDIA or AMD. Total cash and cash equivalents have grown from $22.1 billion to $37.4 billion. Total debt has reduced from $50 billion to $46.6 billion. Debt to equity is 0.4, which is below the threshold of 1 and manageable with profitability projected from 2026 onwards. But here's the number that deserves honest attention. Free cash flow is currently negative at $4.9 billion. Intel is burning cash to fund the massive capital investments required to build its foundry business. Intel is not yet in a position to self-fund its ambitions the way NVIDIA does, with $96.7 billion in free cash flow. Government support, investor partnerships from NVIDIA and SoftBank, and external foundry revenue will all need to materialize to avoid further balance sheet strain. Stay with me, the valuation section is up next, and we're going to find out whether Intel's recovery story is already fully priced in. Even great businesses can be poor investments if you overpay. That principle matters even more for turnaround stories. Intel trades at a forward price to earnings of 112.5. In historical context, the minimum was 19.1, the median was 42.9, and the maximum was 156.9. Intel is trading well above its historical median. Now compared to peers, NVIDIA is at 22, Broadcom at 31, AMD at 51.7. And Intel at 112.5 is the most expensive in the group on a forward PE basis. Intel is trading at a premium to NVIDIA and Broadcom, 2 companies with stronger moats, stronger returns on capital, and better growth visibility. That premium is difficult to justify. Now let's adjust for growth with the price to earnings growth ratio. Intel's long-term analyst earnings per share growth estimate sits around 70.5%. Using that estimate gives Intel a PAG ratio of 1.6. Under 1 points to undervaluation, between 1 and 1.5 is fair for quality companies, and above 1.5 is expensive. At 1.6, Intel lands in expensive territory, even assuming the most optimistic long-term earnings per share growth estimate available. Compare that to NVIDIA at a PAG ratio of 0.65 with a wide moat, or AMD at 1.2 with a narrow moat. The market appears to already be pricing in a successful recovery before it has actually happened. Now let's bring it all together through our 5 key factors. Intel has no moat, driven by manufacturing stumbles that allow TSMC and AMD to overtake it. Returns on capital are recovering from deeply negative territory, the weakest in the peer group, though the trend is improving. Growth is the most uncertain story in the semiconductor space. Earnings per share recovering from minus $0.1 to $2.21 by 2028 is possible, but requires flawless execution across manufacturing, server CPUs, and Foundry simultaneously. Financial strength is improving with a debt-to-equity ratio of 0.4, but negative free cash flow of $4.9 billion reflects the enormous investment burden ahead. And on valuation, Intel trades at a forward PE of 112.5 and a PEG ratio of 1.6, the most expensive in the peer group. Intel's recovery story is real and the direction is right. But at current prices, the market has already priced in the best case scenario. The question is not whether Intel can recover, it's whether you're being compensated for the execution risk at this price. Is the Intel comeback real, or is the market getting ahead of itself? Let me know in the comments.